Welcome, my dear students. This is Dr. Osama Kashu. How are you? Hopefully, everyone is doing well. And I will talk today about in the accounting about a very beautiful topic that is the depreciation. Depreciation. Depreciation is the decrease in the assets in the value of the asset. Like when you buy a car, it's for the first year like $40,000. Second year, it will be $30,000. Third year, the market value of the car will be $20,000. Then the market value of the car will be next year $10,000. That's what we call depreciation. And depreciation means they gradually decrease in an asset's value. How I will calculate the depreciations? The depreciations are calculated by through the next the following equation. Let me share the screen and show you how we will calculate the depreciation. So to calculate the depreciation, we'll say the cost of the asset minus the residuals or the resales value or the scrap divided by the expected life of an asset. As example, if I buy a car with $100,000 in the start of my project, I bought a car to drive it as Uber or whatever. This car was $100,000. After 4 years, it has been estimated that the market value of this car is $20,000 only. So those we call it the market value. And if the value was scrap, means zero. Sometimes it's zero, the value, which is scrap, divided by the expected life of the car. So if we expected that a car will live for about 4 years, so we will say now the assets cost minus the resale value or the scrap value divided by the number of years. So the assets here was the car was 100,000 or a machine or whatever, minus the resales value 20,000 after 4 years, 100,000 minus 20,000 divided by the number of years, which is for 4 years. So this will give me 20,000. This will be per annum or for a year. So that means the decrease in the assets value is 20,000 for a year. Yeah, because the first year it was 100,000. Second year, you will deduct 20,000. It will be with 80,000. Third year, deduct another 20,000. It will be 60,000. Okay, and go on by that way. This is how we will calculate the depreciation. Thank you so much. Thank you. So back to the depreciation, my dear students, back to the depreciation, and I will share the screen. And we can see here in front of us, we said the value of the assets. Let's go to the value of the asset. It was in the start of the beginning, when we bought it, it was $100,000. At the end of the 4 years, it was estimated the car or the machine was only $20,000. But after 4 years, so for every year, the depreciation or how much this assets, the value went down, deducted, how much? So 100,000 minus 20,000 at the end, divided by 4 years, will give me $20,000 per annum or for 1 year. Every year, this value, the value of the car will be reduced, $20,000 will be deducted. We will deduct $20,000 of its value. So if we come to the schedule as example like this table, it shows us now that the first year the car was $100,000. Depreciation was 20,000. So 100,000 minus 20,000. So the value of the car in the start of the second year will be 80,000. Okay. Then the same 100,000 every year we will deduct 20,000. So the second year will deduct 40. So it will be 100 minus 40. It will be 60. Third year will be 60. 100 minus 60 will be the value will be 40. And the fourth year it will be 80. So 100,000 minus 80,000 total, or the accumulated depreciation, we call it accumulated depreciation, 4 years, each year 20,000 deducted, so 80,000 in the 4 years, while the value of the asset in the beginning of the product life, it was 100,000. So 100,000 minus the total depreciation, 80,000. So the assets value at the end of the year 4, or at the start of the year 5, at the start of the 5th year, or at the end of the 4th year, year number 4, is the start of the 5th year. So it will be 20,000. Those we call it table of depreciation. Okay. Also, the amortizations, the same thing is said as the depreciation. So this was, thank you so much for listening. Thank you.